Imagine an ETF inspired by Warren Buffett's investment style. But instead of waiting years for growth, it pays you up to 15% in dividends, consistently. Sounds too good to be true? Well, what if I told you there's an ETF that's flying under the radar, yet it's outperforming JEPI in monthly income payouts? In today's video, we're diving deep into this high-yield cash machine, why it might be a game changer for income investors, how it works, and whether it deserves a spot in your portfolio. Let's break it down. Hey everyone, welcome back to the channel. If you're new here, we talk about smart investing, passive income, and how to build wealth the Warren Buffett way, but with a modern twist. Now, JEPI has become a fan favorite for dividend investors. But today, we're going to explore something potentially better, a Warren Buffett-style ETF that's quietly delivering mouth-watering 15% annual yields. So what is this mysterious ETF? It's called BST, the BlackRock Science and Technology Trust. And while it's not officially tied to Buffett, its strategy mirrors some of his core beliefs, investing in high-quality, cash-generating businesses. BST isn't your average ETF. It blends growth-focused tech stocks with a powerful options income strategy. That combo creates a recipe for passive income lovers, monthly payouts that can top 1.2%, equaling nearly 15% annually. Compare that to JEPI, which is already generous, and you'll start to see why BST is turning heads. BST uses a covered call strategy. That means it owns stocks like Apple, Microsoft, and Nvidia, and then sells options contracts to generate extra income on top of potential growth. The result? Shareholders get a monthly cash distribution that feels like a dividend, even though it's partially derived from options income. And because it's tech-focused, you get a slice of future upside that JEPI might miss, since JEPI leans more toward low-volatility value stocks. Now let's talk about why this fits the Buffett ETF idea. Buffett is famous for buying great businesses with strong moats and solid earnings power. BST invests in companies with long-term dominance just like Buffett would, except it turbocharges your income using options. That's the twist. It's like a high-dividend ETF with a growth engine strapped on the back. Of course, no investment is perfect. BST can be more volatile than JEPI. Tech stocks are cyclical, and option premiums can fluctuate. Also, some of the income you receive may be classified as return of capital, not necessarily a bad thing, but worth understanding for tax purposes. So while you're getting a higher yield, you're also taking on a bit more risk. So is BST better than JEPI? It depends on your goals. If you're focused purely on monthly passive income and want higher cash flow, BST might be the better choice. But if you're more conservative and want lower volatility, JEPI still holds its ground. That said, some smart investors hold both, one for stability, one for growth-driven yield. That balance can work really well if you're building a retirement income portfolio. So what do you think? Could this Buffett-style ETF fit in your portfolio? If you found this breakdown helpful, hit that like button, subscribe, and drop a comment below telling me which dividend ETF is your favorite. Thanks for watching, and here's to building smarter income.